Friends, welcome to our today's discussion on capital structure theories. In the previous class, we have discussed about various kinds of theories, and we also know that the capital structure plays an important role in value maximization of the firm. By changing capital structure, it is possible to maximize the value of the firm. We have understood that concept. We have also understood, or we have also noted, and I had also explained you various formulae which can be used to compute value of the firm. Okay, so by using those concepts, uh, today we'll be continuing with our second class. We'll continue our discussion on the concept of capital structure theories. Going to share the screen with you right now. Let us quickly recapitulate what we have learned in our previous classes. So, what I had told you, these are the four types of capital structure theories which we are going to learn. One is net income approach. Second one is net operating income approach. Third one is traditional approach. Fourth one is the Modigliani and Miller's approach, which is referred to as approach. We'll be learning all these theories one by one. And I had explained you what is the objective of these theories. These theories tells us whether change in capital structure can have impact on value of the firm. When I say change in capital structure, what I mean is that changing the combination of debt and equity in a capital structure, right? And you already know the capital structure means the structure of or the combination of debt and equity. Okay, and the firm which is having debt is referred to as a levered firm, where debt is not there in the capital structure, that is referred to as unlevered firm. And you already know the value of the firm. Value of the firm is equal to S plus D, where S stands for value of shares, D stands for value of debt. Okay, we had already discussed all these things. You are well aware of this. And when I told we'll be learning these four theories has got some common assumptions. Okay, these assumptions has already been explained to you earlier. The logic behind these assumptions are also been explained. Now the assumptions are cost of debt is cheaper than cost of equity. Why it is so? I had already told you. Tax is zero. All earnings are distributed as dividend. Growth rate is zero. And without incurring any transaction cost, a firm can change in capital structure. Suppose firm wants to change the capital structure, convert debt into equity or equity into debt, it will not involve any transaction cost. So these are the common assumptions of all these four theories. Okay. And logic behind these assumptions, I had explained you in your previous class. Then we had also understood or we have learned various formulae. Cost of debt or KD is equal to I by D. Why it is like this, I had explained you earlier. And you can derive from this formula that means D is equal to I by KD. Okay, if cost of debt is equal to interest by value of the debt, that value of the debt is equal to I by KD. It's a derived formula. Similarly, cost of equity is equal to earning before tax divided by value of equity, or S is equal to, or value of the equity is equal to EBT by KE. This is derived. KO or overall cost is equal to EBIT by V. Therefore, V is equal to EBIT by KO. And you already know V is also equal to D plus S. Value of firm is equal to value of debt plus value of sales. Okay, are you getting me? Yes or no?
Yes, sir.
Okay, you have understood this thing? Yeah. Then again, some related formulas also we have understood. KD is equal to interest by market price of debt. Therefore, debt, market price of debt is equal to interest by KD. KE is equal to D1 by P0 plus G. This also logic why it is that I had explained in a previous class. Okay, if you are finding it difficult to understand these days, please report to our previous video, which is already available at YouTube. You'll be able to understand. So KE is equal to D1 by P0 plus G, that is future dividend divided by price at time present price plus growth. Okay, and we can derive from this formula, from the above formula, P0 is equal to D1 by KE minus G. Overall cost, which is KO, is equal to cost of debt into debt by value plus cost of equity into share by value. Okay, that means cost of debt into debt's proportion in total capital plus cost of equity into equity's proportion in the total capital. Okay, so these two when added will get overall cost, or overall cost is equal to EBIT by V. Okay, and overall cost is also equal to KD multiplied with D by S plus D, because you know D is equal to S plus D, plus KE multiplied with S by S plus D. Okay, the value of the business or V is equal to S plus D. Okay, are you getting me? If you have understood this thing, we can move ahead. Okay, this is the structure I had shown you. Revenue less operating expenses, you get profit before interest and taxes minus depreciation. You get profit before interest and tax. Okay, this is prior to that. This is profit before depreciation, interest and tax. After depreciation, you get profit before interest and tax, PBIT or EBIT. Then minus interest, you get profit before tax. Then minus tax, you get profit after tax, or earnings you get it. Okay, this is distributed. Interest is distributed to the debt holders. Therefore, this is the cost of debt. So KD is equal to interest by total value of debt. This amount is distributed to the equity shareholders. So cost of equity is equal to profit after tax or earning or dividend divided by equity. Okay, and profit before tax is the amount which is paid to debt holders as well as equity holders. Therefore, that's the overall cost of capital. So overall cost of capital KO is equal to EBIT by value. Okay. After that, we have understood what is net income theory. You know, there are specific assumptions to this theory. Assumption is that cost of debt is constant irrespective of leverage. Cost of equity is constant irrespective of leverage. And you already know cost of debt is cheaper or cost of equity is cheaper. Which is less costly? Debt or equity?
Debt.
Debt
Debt.
is less
Debt.
costly. Okay. And on that basis, I had given you this example. Then we had discussed that if cost of debt is constant and cost of equity is constant, so if you increase leverage, means increase proportion of debt in the capital structure. If you increase the ratio of debt to equity, then what will happen? That overall cost will come down. Overall cost will come down like this. Why overall cost will come down? Because I'm increasing leverage. Okay, let us say debt was this much, but I'm increasing more debt. More debt means more cheaper fund. I'm substituting a costlier source with a cheaper source. So my overall cost will come down. Okay. Example I had given you earlier. So I had told you like this. Suppose winter season you can get cauliflower and potato curry. You can find out the ratio of cauliflower is more because that is cheaper. But maybe in summer season you may find in the same hotel you may find the ratio of potato is more because cauliflower is costlier. What happens when the costlier item is substituted with a cheaper item? The overall cost comes down. The farm tries to maximize the value by changing the capital structure like this. Okay, if overall cost comes down, the value of the farm will increase. Okay, so this is the conclusion of net income theory. As the proportion of debt increases, KD and KE being constant, and KD being lower than KE, KO falls. Okay, KD is lower and I am increasing the proportion of lower sources. So overall cost will come down. When overall cost comes down, value of the farm increases. So this theory recognizes that debt has a positive impact on value of the farm. Meaning, if you increase debt, value of the farm will go up. Okay, since a costlier form of funding, that is equity, is substituted by cheaper form of funding, that is debt, the overall cost of capital keeps coming down. This means that the optimal capital structure is one which is having lowest KO. So when you try to arrive at the optimal capital structure, we try that where cost will be minimum. cost will be minimum, value will be maximum. Value of the farm will be maximum. So this theory says cost will be minimum where you maximize debt, because more debt means overall cost is low. Okay. Now, to understand this theory, let us try this example. Let us see this question. As you can see, this is a question where three farms are involved: farm A, farm B, and farm C, and EBIT. What is EBIT? Who can tell me? EBIT stands for
earning before income and interest and tax.
earning before interest and taxes. You see, in all the three farms, what is EBIT? How much is the EBIT?
20,000 for all funds.
Yeah, 20,000 in all the cases. Now you see interest. How much is interest in farm A?
3,000.
And in farm B?
6,000.
Farm C?
9,000.
Okay. Now looking at the interest figure, can you tell me which farm has got more debt? Where debt is more in its capital structure?
The C, farm C.
C farm. When you are saying interest is more, then
Debt is more.
debt is definitely more. And question also say cost of equity is constant, that is 10%. And cost of debt is also constant. How much it is? 6%. Now we have to compute the value of the farm. Okay. Now how to compute the value of the farm? Now you please take a piece of paper and pen. So let us try to solve this question. Are you ready with pen and paper? Are you ready? Keep your pen, paper, and calculator ready. Let us try to solve it. Now you see how we are going to solve it. So EBIT, you can open a table like this. EBIT in all the three farms, 20,000, 20,000, 20,000. You know this, it is given in the course. Okay. Right?
Yes, sir.
Now interest, it is already given to you 3,000, 6,000, 9,000. You can write down interest is 3,000, 6,000, 9,000. Okay. Now what is EBT? Earning before interest and tax is this one. Interest is this one. What is earning before tax? How much? 17,000, 14,000, 11,000. Okay. EBIT minus interest, you'll get EBT. Okay. 20,000 minus 3,000, 17,000. 20,000 minus 6,000, 14,000. 20,000 minus 9,000, 11,000. Okay. Now, friends, the question has told us to calculate the value of the farm. We'll be calculating. For that thing, we need to calculate value of debt, value of shares, and overall value, or the value of the farm is the value of debt and value of shares. So how to calculate? We have to use this formula. Already I had explained you in previous class. D can be calculated by using this formula, interest by KD. Can you calculate D? That is, what is the value of debt? Can you calculate? Interest figures are given to you. Okay. And you know, this is calculated on debt value. And debt is equal to interest by KD. What is KD? KD is given to you. KD is how much? Cost of debt is 6%. Cost of equity is 10%. Okay. Now, can you calculate value of debt? All the three cases. Please calculate value of debt. Interest divided by KD. KD is 6%. How much is In case of farm A,
50,000 is coming.
farm B,
1 lakh,
farm C.
1.5.
Okay. So this is the amount of debt. 50,000, 1 lakh, and 1 lakh 50,000. All of you understood this? Yes or no?
Yes, sir.
Yes, sir.
Okay. Now, next thing is that we have to calculate the value of share. Value of share after interest is gone, this amount will go to the shareholders, right? Earning before tax. And assumption is that there is no tax, there is no retention, entire money is distributed. So this money is the dividend and this will go to the shareholders. So this is my cost of share or cost of equity. And question says K is 10%. So what is the value of share? Okay, value of share is equal to EBT by K. Why EBT by K? Because this is the cost of equity. This amount I am paying to the equity shareholders. But how much is the equity? How to know that? So EBT by K. So K is how much? Who has remembered what is K?
10%.
10%. If K is 10%, please compute the value of S in all the three situations.
So 1,70,000, 1,40,000, and 1,10,000.
Okay. Friends, please watch. This is the calculation. So as you can see, K is how much? 1,70,000, 1,40,000, and 1,10,000. Okay. All of you have arrived at D and S figures. I think there is no issue. Now, what is value of the? Yeah. Is there any doubt? No. Okay. What is the value of the farm? Can you compute? There are two ways of computing it. You know, value of the farm is equal to D plus S. And you also know that value is equal to EBIT by KO. KO is not given to us. We will find it out. By using that formula, we'll be finding out what is KO. So can you arrive at the value of the farm? How much is the value of the farm?
2,20,000, 2,40,000,
Yes.
and
You have to just
2,60,000.
add D plus S. You can get 2,20,000, 2,40,000, and 2,60,000. And you also know that this V, the value of the farm, is equal to EBIT by KO. Okay, EBIT figures are given to you. Okay, V is also given to you. And by using those things, you can find it out. KO. KO is equal to EBIT by V. If V is equal to EBIT by KO, then KO is equal to EBIT by V. Is it done? So can you find out what is overall cost? Are you trying? The first case, EBIT is 20,000 and the value is 2,20,000. So what is KO? Are you calculating?
0.9.
Okay. So you see the KO
0.9 is
calculation.
coming.
Okay. KO calculation will be like this, and it comes to 0.09. Second case, 8.33.
0.09.
Third case, 7.7%. Okay. Okay. Any doubt here up to this? Is it clear to you? Do you have any doubt? Is it clear to you?
Yes,
Okay.
yes,
Now,
sir.
okay. Now, what are you observing here? You see, the overall cost has gone up or come down. My question is that if you see the farm A debt is less, farm B debt is little more, farm C debt is far more. That means what you are observing that as we increase the proportion of debt, okay, you see debt is here 50,000, 1 lakh 50,000, 1 lakh 50,000. So debt is increased, okay, debt is increasing, debt is showing an increasing trend or not?
Yes,
Yes, sir.
sir.
Okay, when debt is increasing, what effect it is having on overall cost? Overall cost is also increasing, or it's showing some other trend.
It is decreasing.
It is decreasing. So as you see, that means this theory says as I increase the proportion of debt in the capital structure, my overall cost will come down. And this, when overall cost comes down, what will happen with the value of the farm? Value will go up or come down? Value is showing what trend? Value is increasing or decreasing? Increasing. So you see, value of the farm is also increasing. If you compare the value of the farm, 2,20,000, 2,40,000, and 2,60,000. Okay, but did you understand why it happened? It happened because I reduced the overall cost. How I reduced the overall cost? Because I substituted equity with debt. Equity was 10%, debt was 6%. So I removed equity and added some debt to it. Okay, the kind of planning that the Dawawala is doing when making this cauliflower and potato curry, same thing also, same logic we are applying here. When potato becomes costly, so you will add more cauliflower. And when cauliflower becomes costly, we'll add more potato. Okay, so that overall cost can be minimized, overall cost can be less. When overall cost is less, value of the item can be more. Are you getting this example?
Yes,
Okay.
Yes, sir.
So this is the observation that we are making, that the value of the farm is increasing, or inversely, the cost of capital is decreasing with introduction of debt. Here, cost of capital means overall cost. Overall cost is decreasing with introduction of debt. In other words, introduction of debt has an impact on value of the farm. Are you agreeing to this? Debt has an impact on value of the farm or not?
yes, sir. Yes.
Or you can also say, higher the debt, higher will be the value of the farm. So that is what this particular theory suggests. If the value is more, value of the farm will also. Okay? Understood this? Yes or no?
Yes, sir.
Now, having covered this, we'll move to the next theory. Next theory is net operating income. As I told you that as per our syllabus, we have to read these four theories. Right? These are the four theories we are going to learn. Net income theory or net income approach. Next is net operating theory. Then traditional approach. Then MM approach. So next is net operating theory. Our second theory we are going to learn now. Now, as you know, or from the very beginning, I had told you some general assumptions. General assumptions mean those are the assumptions which are common to all the four theories. Now, just like previous theory was also having some specific assumptions, this theory is also having some specific assumptions. These are four assumptions. I request some of you read the first one, assumption number 1. Please read it out. Anyone can read.
First, with introduction of more debt in the capital structure, the firm will become riskier for the equity shareholders. Hence, cost of equity will increase with leverage.
Okay, let us understand this first. First assumption we need to understand. So previous theory we know that, or we have learned that introduction of the debt is better. If you introduce debt, then value of the firm will increase. But this theory says with introduction of more debt in the capital structure, the firm will become riskier for equity shareholders. Equity shareholders are the real owners of the organization. If you take more debt, this theory says that they will perceive the firm is riskier. Why firm is riskier? Because debt is a fixed commitment. If you take a debt, whether you earn profit or you do not earn profit or you suffer from loss, still you have to pay interest. Is it not? You have to pay interest irrespective of result of your business. If your business is successful or failure, that doesn't matter, you have to pay interest. So
Yes, sir.
that's because of that fixed commitment, you are taking a risk. Okay. You are giving a commitment to a fixed sum of money, even if there is no profit. So that when that situation arises, the equity shareholders feel that this firm is risky. And since they're investing in the risky project, they will be demanding more or not. They will be demanding more, or they will be demanding less. Their expectation will be more or less. They're investing in a risky project. Can you tell me what will be their expectation? Are you getting me?
So, the expectations of shareholders.
Expectation of shareholders. When shareholders are making investment in a risky project, their expectation will be more or less. For example, suppose you are a shareholder. Okay. So you are investing in a project, you find it is less risky. Suppose you are investing in a steel plant. So you feel it is less risky and you are expecting 20% return. Okay. But again, I'm saying you, okay, you can invest in steel plant or you can invest in a movie business. You can invest in a movie and you feel movie business is risky. There is a possibility that movie may become a hit or it may flop also. So if you are investing in a movie business, will you expect same 20% or you will expect more or you will be expecting less? What will be your expectation?
Sir, more risk, more expectations.
You will be expecting more because you are taking more risk. Is it not? When you take more risk, your expectation will be more. Okay. Suppose in a project you are expecting 20%. Another project is more risky, then you will be expecting more. The same concept this theory is saying that when the firm takes more debt, it becomes riskier. When it becomes riskier, then equity shareholders will expect more. Okay. When they expect more, that means cost of equity cannot be constant. Cost of equity will go up. Therefore, the cost of equity will increase with leverage. With leverage means debt in the capital structure. Okay. So if there is a debt in the capital structure, cost of equity will go up. Understood the first assumption?
No, sir.
Not understood. Okay. So this particular assumption says that if you add more debt or if a firm takes more debt, if a firm introduces debt in its capital structure, the business will become risky. When the business becomes risky, equity shareholders will expect more, meaning cost of equity will increase. Did you understand?
Yes, sir. Got, sir.
Okay. Okay. That is first assumption. Now let us see the second assumption. Please read out the second one.
Cost of equity will increase in such a manner that overall cost of capital remains constant.
Okay. Cost of equity will increase, we agreed. Now how much To what extent cost of equity will increase? Second assumption says the cost of equity will increase in such a way that overall cost of capital will remain constant. In the previous theory, we had understood that KD is constant, KE is constant, but KO falls. That means KO goes down. KO goes down, that is overall cost goes down, therefore value of the firm increases. But this theory says no, cost of equity will increase, but it will increase in such a way that overall cost will remain constant. Okay, meaning this means KD is constant, but KE is increasing, but KO is also constant. This is the assumption of this theory. When you do an example, it will be you will be understanding it in a better way. Okay. Now let us read the third assumption. Third assumption, please read out.
Net operating income theory capitalizes the earnings first to arrive the value of the firm. Therefrom, the value of the debt to arrive at the value of shares.
In the previous theory, you have understood that first we need to arrive at the value of the shares, then value of the debt, then we can add up, we can find out value of the firm. Okay. But this theory says that value of the share is a derived figure. So we'll arrive at the value of the firm. Theory says value of the firm is constant. We'll arrive value of the debt. Then by subtracting the value of the debt from value of the firm, we'll be getting value of the shares. Okay. So the formula here will be V minus D is equal to S, or S is equal to V minus D. Okay, understood these assumptions?
Yes.
Okay. Now let us try to understand this theory. Now again, I am showing you the same kind of graph. Okay, in the horizontal axis, I am showing you leverage. Leverage means debt by share, or you can say debt by value. So in fact, this particular line shows increase of debt in the capital structure, or you can say proportionate increase of debt in the capital structure. And on the vertical axis, I'm showing cost. And first, I'm saying the KD is constant. That means irrespective of the leverage, irrespective of amount of loan, whether amount of loan is 0 or amount of loan is 50, KD is constant. KD is same. Suppose KD is 10%, is 10% for any amount of loan. That is the meaning of KD is constant. Okay. Understood.
Yes.
And you know, when leverage increases or debt increases, firm becomes more risky. Okay. Since the firm becomes risky, as I increase leverage, my cost of equity will go up. Cost of equity is not constant in this theory. Cost of equity will go up. Why it will go up? Because equity shareholders are perceiving that firm is more risky. Okay. Are you getting me?
Yes.
Okay. It's more risky. Okay. Now, what will happen? As now you can see, when I increase, let us say, when I increase the proportion of the debt is constant. Okay. So debt is increasing. Debt I am increasing. And equities, cost of equity is also increasing. When I'm increasing the debt, what I'm doing, I'm reducing the equities proportion. I'm substituting equity as debt, is it not? So what exactly happening? I'm reducing equity, but equity cost is increasing. So this thing will make the overall cost as a straight line. That means overall cost will not change. Why overall cost will not change? Because normally when I increased debt, what should have happened? Overall cost should have come down. In the previous theory, we have understood when I increase the debt, overall cost what should have come down or not?
Yes, sir.
It should have come down. But why it is not coming down? It is coming down, but immediately debt cost is increasing. Let us say it is coming down 5%, but cost of equity is increasing by 5%. It is coming down another 2%, cost of equity is also increasing 2%. Okay, so the increase of cost of equity is not allowing the overall cost to come down. So therefore, even if I'm increasing the cost of debt, cost of equity since increasing, overall cost remains constant. Did you understand or not? Little complex for you, right? Did you understand or I'll explain it again?
Sir, you told that cost of debt will simultaneously increase or decrease.
No. Cost of debt will not increase. I have not told you that. I have told you cost of equity will increase. Cost of debt is constant.
That
Cost
will
of,
increase, sir, but constant.
cost
So
of
overall
equity,
cost should go right.
overall cost will remain constant. Why it will remain constant? Overall cost, earlier logic we have already understood in the previous theory. When I increase the proportion of debt, overall cost should come down. Okay, net income theory, overall cost should come down.
Yes.
But overall cost, why it is not coming down? Because cost of equity is also increasing. So the increase of cost of equity is offsetting the reduction in overall cost. Therefore, overall cost is constant. Okay,
Yes, sir. Sir.
Yes, sir, got it.
did you understand or not?
Yes, sir.
Let me explain you with the help of one more example. You can call it leverage or debt, proper debt is increasing, or you can say debt by equity or debt by share. Okay, in horizontal axis, I am taking this. Vertical axis, I am taking cost. Let us come to the first theory. What was the first theory? Was remember first theory that we have learned. What was that? Which theory?
Net income theory.
Net income theory says this is my cost of debt, this is my cost of equity. Okay, it says as I keep on increasing debt, as I increasing leverage, or as I keep on increasing the proportion of debt in my capital structure, okay, what I will do, my overall cost will come down. KO will come down. Why KO will come down? Because this is costly, and costlier thing I am removing, and cheaper thing I am adding. Now you take that example of that roadside dabawala I had told you earlier classes. Let us say he is making a curry of cauliflower and potato, and he is selling it at 50 rupees. Okay, he's selling it at 50 rupees, and the cost is 40 rupees. Cost, are you able to see it? No. Now you see, let us say cost is 40, selling 50. What is the value? What is the value of that plate of curry? How much?
10, 10 rupees.
10. Value of the curry is 10. Why this is the value? Because when it will be sold, his wealth will be maximized by 10 rupees. By selling one plate of curry, he will be able to maximize his wealth by 10 rupees. So that is the value of that curry plate. Now let us say he's changing the cost by changing the structure. How he is changing? He's adding more potato and less cauliflower. Possible? Okay, cauliflower is like equity. It is costlier. Potato is cheaper, like debt. He's adding more cauliflower. Sorry, he's reducing cauliflower, adding potato. So this 40 may become 30. This theory says if you change the proportion, if you increase the proportion of debt, cost will become less. When cost will become less, what will be the value? Value will be more or less. How much will be value in this situation?
20.
20. So that was my first theory. That was our first theory, what you have understood. Okay, net income theory. It says you since cost of debt is constant, cost of equity is constant, you are changing the proportion, you are reducing the overall cost will come down. When the overall cost comes down, value of the farm will go up. Understood this theory?
Yes, sir.
But the second theory says right. You are right that you can change the proportion and reduce the cost to 30. But equity shareholders will perceive it is risky. Now, if you are doing that, if you are reducing the 30, the customers who they are coming, they are saying, no, it is not that curry. I am not going to buy it at 50 rupees. You have added more potato and reduced cauliflower. So I am going to buy it only at 40 rupees. Then what will the value of the farm?
Same.
Same 10 rupees.
10 rupees.
Same 10 rupees. Now you see, by changing the proportion, overall cost is not changing. Sorry, changing the proportion, value of the farm is not changing. Why value of the farm is not changing? Because the perception of purchasers changed. Okay, purchasers are not accepting it as the same product. When that got changed, okay, their expectation got changed. You see, value remains same. And the second theory, same thing is also same. Second theory says if you increase debt, the equity shareholders will not keep their cost constant. Okay, let us say for no debt, this is the cost. If you increase debt, equity share cost will increase like this. KE will be increasing. Okay, so when you increase the leverage, overall cost should come down. It should come down. But when it is coming down, overall cost is increasing. So this much it is coming down. Sorry, this much it is coming down. And this much it is going off. Therefore, overall cost will remain constant. KO will remain constant. Did you understand this theory now? It is constant because to the extent it is coming down, by the same extent it is also going off. Did you understand or not?
Yes, sir.
It's clear to you? Okay, good. Now, yeah. Now you have understood that is why KO is constant. KO is constant because KE is increasing. Okay. So that means this particular theory says that changing the capital structure or introduction of the capital structure will not be having any impact on value of the farm. You cannot change value of the farm. Just like you have seen that the value of that curry remains same 10 rupees. Don't think that the changing the capital structure you will be able to maximize the value. No, it's not possible. Okay. So this theory says something which is different from our previous theory. Okay. So there are two different school of thoughts they're talking about in two different things. Now, to understand this particular issue, to understand this particular theory, we'll do this example. Just go through this example. Example 4 and keep your pen, paper, calculators ready. We'll be solving this one. As you can see, there are three farms and EBIT in all the three farms Or how much? What is the EBIT?
20,000.
20,000 each. And interest, tell me the interest.
From A 3,000, from B 6,000, and from C 9,000.
Okay, that itself shows that which farm has got more debt, which farm has got less debt. Which farm has got the highest debt?
From C,
Farm C. Which farm has got lowest debt?
A from
So if you follow the previous theory, that is net income theory, here debt is maximum, the value of the farm should be maximum, farm C. Okay, but this theory says no. Why it is no? It says KD is constant. KD you see is 6%, 6%, 6%. But KE question has not given you the KE. KE is definitely increasing. KE is increasing in such a way that overall cost is coming to 10%, 10%, 10%. Question has given you KO and KD. KE you have to compute and you have to also comment on the value of the farm. Did you understand this question? Should we solve it now?
Yes, sir.
Okay. Now be ready. We'll be solving it right. Now you can take down. You can open a table. Farm A, B, and C. EBIT 20,000, 20,000, 20,000. Interest given in the question 3,000, 6,000, 9,000. You know how to compute EBT? How to compute EBT?
EBIT minus interest.
EBIT minus interest. So 20,000 minus 3,000, 17,000. Next, 20,000 minus 6,000, 14,000. Then 20,000 minus 9,000, 11,000. Now we will be computing value. We'll be computing debt value. We'll be computing equity value. We'll be computing cost of equity. To compute these things, the formula that we have learned will be useful to us. First, let us compute the value. Since EBIT is given to us, KO is also given to the person. Given us in the question, KO is 10%. All the cases, KD is 6%. So please try to compute V. Okay, V is equal to EBIT by KO. KO is 10%. So please compute value of the farm. Do it quickly.
2,000 is coming, sir.
How much?
2 lakhs.
2,000.
2 lakhs.
Acha.
2 lakh, 2 lakh, 2 lakh.
Yes, sir.
Okay, all the cases it is 2 lakh because EBIT is constant. KO is also constant, 2 lakh. So as you can see, value of the farm has not changed, even if interest figures are different. Now let us compute what is the value of the debt. How much debt was there? Interest is this much, and cost of debt you already know 6%. KD is 6%. Can you compute value of debt? D is equal to how much? Can you compute? D is equal to I by KD. I figures are given to you 3,000, 6,000, and 9,000. KD is 6%. Can you compute debt value?
Hmm.
50,000.
50,000.
Okay, then farm A you are saying 50,000. Farm B and C.
From B 1 lakh and C 1,50,000.
Okay, so this is the value of debt 50,000, 1 lakh, 1 lakh. Can you compute S now? You know S is equal to V minus D. Here in this theory, we are saying that value of equity is a derived figure. Value of the firm minus value of the debt. Earlier we have understood that S plus D is equal to V. Here S is equal to V minus D. Can you calculate value of equity?
Yes, from A 1,50,000, from B 1 lakh, and from C 50,000.
Good. Now you see, value of equity, what has happened? It has gone up or come down. When debt increases, what has happened to us? Value of equity.
It is increased.
Value of equity is
Increasing for the theory.
value of equity is increasing or decreasing, you see. 1,50,000, 1,50,000. Okay, total value is same, 2 lakh. Debt is increasing, but by the same extent, share value is decreasing. Total, if you see here also debt and equity taken together 2 lakh, here also 2 lakh. Here. But as the debt increases in the proportion, value of equity decreases. Okay. Now let us compute what is cost of equity. What has happened what has happened to this cost? Cost of equity is equal to EBT by S. That is EBT by equity. Can you compute cost of equity?
Eleven percent.
How much?
11%.
Second case, and third case,
0.6.
Then 14.
okay. Are you able to get these figures? 11.33%, then 14%, then 22%. Okay. Now, what is your observation? Cost of equity has gone up or come down when you increase debt in the capital structure. I am increasing the debt and reducing equity. But what impact it is having on cost of equity? Is it going up or coming down?
The cost of equity is going up, increasing.
Cost of equity is increasing. Cost of equity is increasing, and value of the firm is constant. Okay, and value of debt is of course constant. Understood? So if you summarize, if you conclude that introduction of debt has made the company riskier. Consequently, there is an increase in cost of equity. That increase is made in such a way that the overall cost remains constant. Okay. Increase in cost of equity is offsetting the reduction of cost that is expected when you introduce more debt in the capital structure. Understood these points?
Yes.
So, formula wise, if you try to calculate what is cost of equity is higher than cost of this debt, always higher than cost of debt. It is also higher to overall cost. So, cost of equity is computed like this: overall cost of capital plus debt by share, that means proportion of debt to proportion of share, multiplied with overall cost minus cost of debt. Okay, so overall cost plus, when this will be added,
Sir, your voice is not coming.
you will be getting cost of equity. Voice is not coming for all. Are you able to listen to me?
No, sir, just audible.
It's
Maybe
okay.
network issue from.
Is it okay for you?
Yes, sir.
Yes, sir.
Okay, okay, right. Maybe in some
It's
cases, some
breaking
specific.
a little bit.
Yeah. So you see how to calculate cost of equity, cost of capital plus debt by equity multiplied with the difference between cost of capital and cost of debt. So this is by using, under this theory, we will be able to compute cost of equity by using this overall cost plus debt by equity into difference between overall cost minus cost of debt. Okay. Now let us try to understand why this is happening. Why uh, value of the farm is not changing. Why overall cost is not changing. This is because when you take a debt, debt has got a cost. In fact, it has got two types of cost. One is called as explicit cost. Explicit cost is the interest what we pay for debt. That is expressed in the debt agreement. That term is expressed. We know that suppose we have to take a debt, we have to pay 6%, or we have to pay 10%, or we have to pay 15%. That is the cost of debt, but that is referred to as explicit cost. Understood? But there is one more cost which is called as implicit cost. Implicit cost is not expressed, but it is implied. Right? Interest is payable, but because of debt, my some other cost is increasing. Like my cost of equity is increasing because I'm taking debt. Why it is increasing? Because my equity shareholder is thinking that business is risky. He is expecting more. Equity shareholder, who was expecting, let us say 10%, he is now asking me 25% because he feels that I have taken extra risk. So that cost, that is increase in cost of equity, is referred to as implicit cost. Okay. So because of this implicit cost, my overall cost is not falling. Overall cost is remaining constant. Right. So explicit cost represents the interest payable, whereas implicit cost represents the increased cost of equity. Why there is an increase in cost of equity? Because there is an increase in the risk perception of equity shareholders. Okay. Debt is definitely has an advantage because debt is cheaper, but the advantages which arises on account of cheaper debt exactly offset the increased cost of equity. Okay, increased cost of equity is offsetting the advantages of cost of debt. Therefore, this combination or this situation is making overall cost is allowing the overall cost to remain constant. Overall cost is not changing. When overall cost is not changing, value of the farm is also not changing. That's also constant. Okay. So if you compare now, net income theory says like this: K is constant, KD is constant, but overall cost will fall. But net operating income theory says KD is constant, but K is not constant, K is increasing, because of which KO is a straight line and KO is also constant. Did you understand both the theories? This is the difference between both the theories. Just have a look. Or we can conclude the first theory says that capital structure has an impact on value. But the second theory says capital structure doesn't have an impact on value of the farm. Why? Because capital structure is changing, not changing the overall cost, not changing the value. So there are two different theories. They're talking from two different angles. Did you understand this?
Yes, sir.
Yes. Yes, sir.
Good. Now, if you have understood, then we can move to the next theory, which is the traditional approach. We'll be learning it in our next class. But at this stage, let me tell you, this is, you can say, this is somehow a mixture of both the theory. That means you can say, to some extent, that net income theory will be applicable, and maybe beyond that, net operating theories will be applicable. That means it's not necessary that always overall cost will remain constant. It may remain constant for some time. After that, it may come down. Okay, so that is what we will be learning in our next theory. That is our traditional approach. Then one more approach which is totally different, Modigliani and Miller's approach. That also we are keeping for our next class. If you have any query, then let me know very quickly. We'll be addressing those issues, or else we are going to wind up now. We'll catch up in our next session. Any query you are having, please feel free to tell me.
Sir,
Yes, tell me.
sir, can I request you to take more classes per week so that syllabus will be completed early?
Yeah, we'll try. We'll try to do that.
Because syllabus exam will be on 1st June.
Okay.
Yesterday notice.
You have started studying?
Yes, sir, started.
Okay. You see, most of the chapters, if you visit my channel, already recorded videos are available.
Yes, sir.
Okay. Last year's recorded videos are available. So, of course, we'll be covering in our regular classes. But instantly, if you're looking for something, then you can visit to my channel in YouTube. You can find out those videos. And you can start
Sir, if I type there, if I type your name Pruchi Rajnan there, all
Yeah.
classes will come.
Yeah,
I
all
have tried,
classes.
but very few. All classes will come. Okay, sir, I will try.
No, you can try it.
And sir, will you take valuation also?
We'll think
Corporate
about
valuation?
this. We'll think about this.
Okay. Yes, sir.
Okay, friends. So now we'll stop here. Thank you very, very much. We'll catch up in your next class. We'll be starting with other theories. Thanks a lot.
Thank you, sir.
Thanks.